I have been investing for over 70 years, and during that time I have watched investment strategies come and go, watched conventional wisdom change, watched what everyone believed was the right approach turn out to be completely wrong. But there is one strategy, one approach to investing that has been considered gospel for longer than I have been alive, that has been taught in every business school and recommended by every financial advisor and written into the guidelines of every pension fund and endowment. The 60-40 portfolio, 60% stocks, 40% bonds. Diversified, balanced, suitable for almost everyone. The foundation of modern portfolio theory and retirement planning. And it is dead. Not dying, not struggling, dead. It no longer works the way it is supposed to work. The fundamental assumptions underlying the 60-40 portfolio have been invalidated by changes in the economy, in the financial system, in the relationship between stocks and bonds, and yet millions of investors continue to structure their portfolios this way, completely unaware that they are following a strategy that is going to produce disappointing results at best and catastrophic losses at worst. I am not being dramatic when I say this. I am not exaggerating for effect. I am telling you based on decades of studying markets and understanding how different asset classes behave under different conditions, that the 60-40 portfolio that worked so beautifully from the 1980s through the 2010s does not work anymore. The environment has changed. And investors who do not understand this and who do not adapt are going to pay a very heavy price over the next decade. Let me start by explaining what the 60-40 portfolio is and why it became so popular. Because you need to understand the theory before you can understand why the theory no longer holds. The basic idea is simple. Stocks provide growth but are volatile. Bonds provide income and stability but grow more slowly. By combining 60% stocks with 40% bonds, you get most of the growth potential of stocks while reducing the overall volatility of the portfolio because bonds cushion the downside when stocks decline. The magic of the 60-40 portfolio was that stocks and bonds were negatively correlated. When stocks went down, bonds typically went up, or at least did not decline as much. This negative correlation meant that the 40% bond allocation acted as a shock absorber, protecting the portfolio during stock market declines. And during normal times, the bond allocation provided steady income through interest payments, while the stock allocation provided capital appreciation. From the early 1980s through about 2020, this strategy worked spectacularly well. Stocks produced strong returns, bonds produced decent returns, and the combination of the two created a portfolio that grew steadily with manageable volatility. Retirees could withdraw 4% per year from a 60-40 portfolio and have a very high probability of not running out of money over a 30-year retirement. Endowments and pension funds use variations of the 60-40 portfolio to meet their obligations while preserving capital. The 60-40 portfolio became so entrenched, so accepted, so universal that questioning it was considered heresy. Every financial planning tool, every retirement calculator, every asset allocation model started with the 60-40 portfolio as the baseline. Minor variations were made based on age and risk tolerance, but the fundamental concept of combining stocks and bonds in roughly these proportions was treated as an immutable law of investing. But here is what people did not understand or chose to ignore. The success of the 60-40 portfolio from the 1980s through the 2010s was not because the strategy itself was brilliant. It was because we were in an extraordinary period for both stocks and bonds. Interest rates fell from over 15% in the early 1980s to essentially zero by 2020. This 40-year decline in interest rates created a spectacular bull market for bonds. As rates fell, bond prices rose, giving bondholders not just interest income, but also capital appreciation. Meanwhile, stocks benefited from the same decline in interest rates. Lower rates meant companies could borrow cheaply. Lower rates meant that future earnings were worth more in present value terms, supporting higher stock valuations. Lower rates meant there were fewer attractive alternatives to stocks, driving more money into equities. The same force that drove the bond bull market also drove the stock bull market. So the 60/40 portfolio rode two spectacular bull markets simultaneously, one in stocks and one in bonds, both driven by the same underlying factor of declining interest rates. It is no wonder the strategy worked so well. You would have had to work hard not to make money during this period. And investors confused a favorable environment with a brilliant strategy. They thought the 60/40 portfolio was inherently superior when really it was just in the right place at the right time. And now that environment has ended. Interest rates cannot go much lower than zero. They tried to go negative in some countries, and it created all sorts of distortions and problems. The 40-year tailwind of declining interest rates is over. In fact, we may be entering a period of rising rates, or at least rates that remain higher than they were in the 2010s. And this changes everything for the 60/40 portfolio. Let me explain why the 60/40 portfolio does not work anymore, and I am going to be very specific about the problems. First, bond returns are going to be terrible. When you buy a bond, your return over time is determined primarily by the yield when you buy it. If you buy a 10-year Treasury bond yielding 1%, you are going to earn about 1% per year for the next 10 years, assuming you hold to maturity. If you buy that same bond yielding 4%, you will earn about 4% per year. Right now, investment-grade bond yields are in the range of 4 to 5% depending on maturity and credit quality. That sounds okay until you account for inflation and taxes. Inflation has been running well above the Federal Reserve's 2% target. Even if it comes down, it is likely to remain at 2 to 3% going forward for structural reasons I will get to later. So a bond yielding 4% is really only giving you 1 to 2% in real inflation-adjusted terms. And then you have to pay taxes on that bond interest, assuming you are holding the bonds in a taxable account. If you are in a 30% tax bracket, that 4% yield becomes 2.8% after taxes, or roughly zero after accounting for inflation. You are working hard, taking risk with your capital, tying up your money for years, and earning essentially nothing in real after-tax terms. Compare that to the bond returns from the 1980s through the 2010s. Not only were you earning higher interest rates, often 6, 7, 8% or more, but you were also getting capital appreciation as rates declined. Total returns on bonds during that period were often 8 to 10% per year or even higher. Those kinds of returns are not coming back. They cannot come back unless we have another 40-year period of declining interest rates, which is mathematically impossible since rates are already near zero. So the first problem with the 60/40 portfolio is that 40% of your portfolio is going to earn terrible returns. Maybe 3 to 4% nominally, maybe 1 to 2% after inflation, maybe zero or negative after taxes and inflation. This is not an asset allocation that is going to help you build wealth or fund retirement. This is an asset allocation that barely preserves purchasing power in the best case. The second problem, and this is even more serious, is that the negative correlation between stocks and bonds has broken down. For decades, when stocks fell, bonds rallied. This happened because stock declines usually occurred during recessions or during periods when the Federal Reserve was cutting interest rates to stimulate the economy. Lower rates meant higher bond prices, so bonds went up when stocks went down. This negative correlation was the whole point of holding bonds. They zigged when stocks zagged. But in 2022, we saw something that had not happened in decades. Stocks and bonds both declined substantially at the same time. The S&P 500 fell over 20%. The bond market, as measured by the Bloomberg Aggregate Bond Index, fell over 13%. A 60/40 portfolio lost over 17% that year. The bonds did not cushion the stock decline. They fell right alongside stocks, offering no protection whatsoever. Why did this happen? Because the decline in stocks was not driven by recession fears or by the Fed cutting rates. It was driven by inflation fears and by the Fed raising rates aggressively to fight that inflation. When rates rise, bond prices fall. And rising rates also hurt stock valuations because they increase the discount rate used to value future earnings. So both stocks and bonds declined together, driven by the same factor of rising interest rates. This broke the fundamental logic of the 60/40 portfolio. If stocks and bonds move together, if they both decline at the same time, then holding 40% bonds does not reduce your risk. It just reduces your return because bonds have lower expected returns than stocks. You are giving up the higher returns of stocks without getting the diversification benefit that bonds are supposed to provide. This is the worst of both worlds. Now, some people will argue that 2022 was an anomaly, that the normal negative correlation between stocks and bonds will reassert itself, that 1 year does not invalidate decades of experience. And maybe they are right, but I am not convinced. I think the environment has changed in ways that make positive correlation between stocks and bonds more likely going forward. Here is why. Inflation is likely to be structurally higher going forward than it was in the 2010s. Deglobalization means higher costs for goods as supply chains are reshored or moved to more expensive locations. The energy transition means higher energy prices in the medium term as we move away from fossil fuels before renewable capacity is fully built out. Aging populations mean more demand for services and less labor supply, putting upward pressure on wages. Government debt levels mean more pressure to inflate away debt burdens. I am not predicting hyperinflation or anything close to it, but I think 2 to 3% inflation is more likely than the 1 to 2% we got used to in the 2010s. And this higher inflation will keep pressure on the Federal Reserve to maintain higher interest rates. They cannot let rates fall back to zero because that would risk reigniting inflation. So we are in a higher rate environment for the foreseeable future. In this environment, when inflation flares up or when the Fed signals they need to raise rates further, both stocks and bonds will decline together. Bonds because rising rates mean falling bond prices. Stocks because higher rates hurt valuations and because the economic tightening needed to control inflation hurts corporate profits. This positive correlation between stocks and bonds means the 60-40 portfolio will not provide the risk reduction it is supposed to provide. The third problem with the 60-40 portfolio is the opportunity cost. That 40% in bonds is earning low, single-digit returns at best. But there are other assets, other investment approaches that could generate much higher returns with similar or even lower risk. By sticking with the traditional 60-40 portfolio, you are leaving significant returns on the table. You are following a conventional strategy that no longer makes sense just because it is what you have always done or what your advisor told you to do. Let me give you some examples of alternatives. Cash and short-term treasury bills are currently yielding 4 to 5% with essentially zero risk and complete liquidity. Why would you own long-term bonds yielding the same or less with much more price volatility and no liquidity? It makes no sense. You can get similar yields from cash with far less risk. The traditional argument for owning bonds rather than cash was that bonds provided higher yields to compensate for the interest rate risk and illiquidity. But that yield premium has disappeared. Or consider dividend-paying stocks from high-quality companies. Many excellent businesses are currently yielding 3 to 4% in dividends, and those dividends grow over time. Over a 10 or 20-year period, a portfolio of quality dividend stocks will likely produce much higher total returns than a bond portfolio, with the added benefit of inflation protection because dividends tend to grow with inflation. Yes, dividend stocks are more volatile than bonds, but they provide much better long-term returns and better inflation protection. Or think about other asset classes entirely. Real assets like infrastructure, commodities, real estate investment trusts in certain sectors, treasury inflation-protected securities. These assets provide inflation protection that nominal bonds do not. In an environment where inflation is a real concern, holding assets that protect against inflation makes much more sense than holding nominal bonds that get destroyed by inflation. My point is not that any specific alternative is obviously better than the traditional 60-40 portfolio. My point is that investors need to think critically about their asset allocation rather than blindly following a conventional approach that worked in the past but does not work anymore. The world has changed, the investment environment has changed, and strategies need to change to adapt to new realities. Let me talk about what happens to people who stick with the 60-40 portfolio despite these problems. Over the next decade, I believe a traditional 60-40 portfolio will produce returns in the range of 4 to 5% per year nominally. Maybe stocks return 7 to 8%, which is below their historical average because they are starting from elevated valuations. Maybe bonds return 2 to 3%. Blend them together in a 60-40 mix and you get about 5% nominal returns. After inflation of 2 to 3%, you are earning maybe 2 to 3% in real terms. After taxes for people in taxable accounts, you might be earning 1 to 2% real after-tax returns. This is not enough to fund retirement comfortably. This is not enough to build wealth. This is barely enough to preserve purchasing power. And this is the optimistic scenario where everything goes reasonably well. The pessimistic scenario is much worse. If we have a significant stock market correction and valuations are high enough that a correction is quite possible, stocks could return zero or even negative returns over the next decade. This happened in the 2000s when stocks went nowhere for 10 years. If stocks return zero and bonds return 2%, a 60-40 portfolio returns less than 1% per year. After inflation and taxes, you are losing purchasing power every single year. Your retirement savings are shrinking in real terms, even though you did everything you were told to do. And in a true worst-case scenario, if we have a period of rising inflation and rising interest rates, like we saw in the 1970s, both stocks and bonds could produce negative real returns simultaneously. Your 60-40 portfolio could lose 20 or 30% in real terms over a decade. This would be catastrophic for retirees who are depending on that portfolio to fund their living expenses. They would be forced to either dramatically reduce their standard of living or go back to work. This is what I mean when I say the 60-40 portfolio is dead and investors do not know it. They are following a strategy that worked beautifully for 4 decades, but that is not going to work going forward. And they are going to discover this the hard way through disappointing returns and unexpected losses because nobody told them that the environment changed and that their strategy needed to change with it. Now, let me tell you what you should do instead. And I want to be clear that I am not offering a one-size-fits-all solution because everyone's situation is different. Your age, your risk tolerance, your income needs, your tax situation, all of these factors matter in determining the right asset allocation for you. But I can give you some general principles that I think make sense for most investors in the current environment. First, reduce your bond allocation significantly. I do not think 40% bonds make sense for anyone except perhaps people in their 80s or 90s who cannot afford any volatility. For most investors, including retirees, I would suggest 10 to 20% in bonds at most. And even that should probably be in short-term bonds or TIPS rather than traditional long-term bonds. The returns on bonds do not justify a large allocation, and they do not provide the diversification benefit they used to provide. What should you do with that money instead of putting it in bonds? Several options. You can keep more in cash or short-term treasury bills. This gives you similar yields to bonds with much less risk and much more liquidity. You can increase your stock allocation, but only if you have the temperament to handle the volatility and the time horizon to ride out downturns. You can diversify into alternative assets that provide inflation protection or that have low correlation to traditional stocks and bonds. Second, focus your stock allocation on high-quality businesses with strong balance sheets, durable competitive advantages, and the ability to maintain or grow their profit margins during inflationary periods. These are not the sexy growth stocks that everyone is excited about. These are boring, mature businesses that generate consistent cash flows and pay dividends. Companies that produce essential products or services that people need regardless of economic conditions. Companies with pricing power that can pass through cost increases to customers. These high-quality stocks will hold up much better than the broader market during downturns. They will provide growing income through dividends. They will protect against inflation better than bonds. And over long periods, they will produce better risk-adjusted returns than either bonds or lower quality stocks. This is not exciting or innovative advice, but it works. It has worked throughout market history and it will continue to work. Third, consider holding more cash than traditional wisdom suggests. Cash gets a bad reputation because it does not grow. It just sits there earning whatever short-term interest rates are available. But cash has enormous value in an uncertain environment. Cash gives you optionality. Cash lets you take advantage of opportunities when they arise. Cash lets you sleep at night when markets are turbulent. Cash ensures you do not have to sell stocks at depressed prices to meet living expenses. Berkshire Hathaway is currently holding over $150 billion in cash and short-term treasuries, earning about 5% with zero risk. People criticize me for this. saying I should put that money to work. But that cash is working. It is earning a decent return with complete safety, and it positions Berkshire to act decisively when opportunities arise. I am not suggesting that individuals should hold $150 billion in cash, but I am suggesting that holding more cash than you think you need is not a bad strategy in the current environment. Fourth, think about inflation protection explicitly. Do not just assume that your stock and bond portfolio will protect you against inflation. It probably will not, at least not in the short to medium term. Consider Treasury inflation-protected securities, which adjust their principal for inflation. Consider commodities or commodity-related stocks. Consider real estate or REITs in sectors that have pricing power. Consider assets that have historically done well during inflationary periods. I am not suggesting you make radical changes or take big bets on any single asset class, but I am suggesting that a portfolio designed for a low inflation environment, which is what the traditional 60-40 portfolio is, will not serve you well in a higher inflation environment. You need to adapt. You need to include assets that protect against inflation rather than being destroyed by it. Fifth, be willing to hold unconventional allocations that do not match the textbook recommendations. If your financial advisor insists that you must have 40% in bonds, because that is what everyone does, find a new advisor.
If your retirement calculator assumes you will earn 6 to 7% per year on a 60-40 portfolio, recognize that those assumptions are based on historical returns that are not relevant to the current environment.
If your pension fund or endowment is sticking with a traditional 60-40 allocation, understand that they are probably going to underperform and adjust your own planning accordingly. The herd is almost always wrong at major turning points. When everyone is doing the same thing, following the same strategy, believing the same narrative, that is usually the time to do something different. Right now, everyone is still clinging to the 60-40 portfolio despite the evidence that it does not work anymore. This is your opportunity to position yourself differently, to adopt a strategy that actually makes sense for the current environment rather than the environment that existed from the 1980s through the 2010s. Let me address some objections I know I will hear. Some people will say that I am too pessimistic about bonds, that yields are higher now than they have been in years, that bonds are attractive again. And it is true that bond yields are higher than they were in 2020 when the 10-year Treasury was yielding less than 1%. But 4% is not attractive in an absolute sense. It is only attractive compared to the 0% we got used to. In a world with 3% inflation and 30% tax rates, a 4% bond is earning you nothing in real after-tax terms. Others will argue that stocks are expensive and that a large stock allocation is risky given current valuations. I agree that stocks are not cheap, but I would rather own expensive stocks than low-yielding bonds, because at least stocks have the potential to grow their earnings over time and to provide inflation protection. Bonds have no such potential. A bond yielding 4% will give you 4%, period. A stock might decline in the short term, but over a decade or two, quality businesses will likely produce substantially higher returns than bonds. Some will say that my criticism of the 60-40 portfolio is based on one bad year in 2022, that it is premature to declare the strategy dead based on a single year of performance. But I am not basing this on 1 year. I am basing it on fundamental changes in the economic and market environment that make the assumptions underlying the 60-40 portfolio invalid. The 40-year bond bull market is over. The negative correlation between stocks and bonds is broken down. Inflation is structurally higher. These are not temporary aberrations. These are permanent changes that require rethinking traditional strategies. Others will argue that regular rebalancing of a 60-40 portfolio will produce better results than I am projecting. It is true that rebalancing, selling what has gone up and buying what has gone down, can add some value over time. But rebalancing cannot overcome the fundamental problem of low bond returns and positive correlation between stocks and bonds. Rebalancing helps at the margins, but it does not change the basic outlook for the strategy. Let me tell you what I think is going to happen over the next decade. I think investors who stick with the traditional 60-40 portfolio are going to be very disappointed with their results. They are. going to earn returns that barely keep up with inflation. They are going to see their portfolios stagnate or even decline in real terms. And they are going to wonder what went wrong, why the strategy that worked so well for their parents or for earlier generations stopped working for them. And the answer is that nothing went wrong with their execution. They did everything right according to the conventional wisdom. The problem is that the conventional wisdom is based on an environment that no longer exists. The problem is that they were following a strategy designed for a different era with different inflation dynamics, different interest rate trends, different correlations between asset classes. Meanwhile, investors who recognize that the 60-40 portfolio is dead and who adapted their strategies accordingly are going to do much better. They will earn higher returns. They will protect against inflation more effectively. They will preserve their purchasing power and their standard of living. And they will look smart, not because they had some special insight or superior skill, but simply because they were willing to question conventional wisdom and to think independently about what makes sense given current conditions. This is not complicated. This does not require sophisticated financial modeling or access to exotic investments. It just requires being willing to look at the world as it is rather than as it used to be. It requires understanding that investment strategies that worked in one environment may not work in a different environment. It requires intellectual flexibility and the courage to deviate from what everyone else is doing. I have spent my career trying to think independently, to question conventional wisdom, to adapt to changing conditions. This has served me extraordinarily well over 7 decades of investing. And I am telling you that right now, in 2025, the conventional wisdom around the 60-40 portfolio is wrong. It is based on assumptions that no longer hold. It is going to produce disappointing results for people who follow it. And it needs to be replaced with strategies that actually make sense for the environment we are in. The 60-40 portfolio is dead. It died when the 40-year bond bull market ended. It died when the negative correlation between stocks and bonds broke down. It died when inflation became structurally higher than the low levels we got used to in the 2010s. The corpse is still walking around because millions of investors and advisors have not yet realized that it is dead. But it is dead nonetheless. And investors who do not recognize this, who continue to allocate their portfolios according to this dead strategy, are going to pay a heavy price over the next decade. They are going to earn inadequate returns. They are going to fail to meet their financial goals. They are going to find that their retirement plans are underfunded and that they need to work longer or live on less than they anticipated. This does not have to happen to you. You can recognize that the environment has changed. You can adapt your strategy to reflect current realities rather than past performance. You can structure your portfolio to actually provide the returns and inflation protection and risk management that you need rather than following a conventional approach that no longer works. The 60-40 portfolio served investors well for many decades. I am not criticizing the people who recommended it or the people who followed it during the period when it worked. But that period is over. The world has changed, and successful investors must change with it. Those who adapt will prosper. Those who cling to outdated strategies will suffer. The choice is yours. This is Warren Buffett telling you that the 60-40 portfolio is dead and that investors do not know it yet. But now you know. The question is what you are going to do with that knowledge. Are you going to adapt your strategy to reflect this new reality, or are you going to keep following conventional wisdom and hope that somehow it starts working again? I know which choice I would make. And I hope you will make the same choice for your own financial security and your own future.